All right, man, let's get into it. Let's get into it. So, I made a video recently about SCHD, which is a dividend ETF. And I'll start talking about the drip method and dividends and all of this kind of stuff. But I was getting a lot of questions about what is a dividend? What is a dividend? So, I need to, back up. I need to back up and remember to stay with the basics because everybody's at different paces. I can't assume that everybody knows everything. So today we're going to be talking about the basics of dividends. What is a dividend and why you should consider adding a dividend stocks or dividend ETFs or anything like that to your portfolio. So, what is a dividend? Let's just make it simple. Let's say I have a company. I have a company, you're invested in my company. Let's say you have 10 shares. I have 10 shares in my company and my company is doing great. I'm profitable. Everything's good. I have $1 million in excess money. $1 million in excess money, and I want to reward my investors. I want to reward my investors. I have excess money. I don't need to put it into research and development. I don't need it to develop my company. I don't need it for anything. It's just excess money, extra money. So, as a company, I can do a dividend payout. Remember, I told you I have $1 million in excess money. I have $1 million in excess money. And let's say I have 1 million shares outstanding also. So, my company has 1 million shares of stock out there, 1 million shares of stock out on the stock market. And I want to pay out $1 million in dividends. So, that would mean that I would be paying out $1 per share in dividends. Remember, I told you I told you had 10. Let's just say you got 100. Because you got 100 shares in my company because you believe in me. You believe in me, you believe in B, and you bought 100 shares of that thing. I appreciate you. You bought 100 shares of my company, and it's 1 million shares outstanding on the stock market of my company, and I want to pay out $1 million in dividends. I want to pay out $1 million in dividends. So I'm gonna pay out $1 million in dividends. You have 100 shares. So 1 million divided by 1 million, you do the math. That means you're gonna get $1 per share because it's 1 million shares. I'm giving up $1 million. That's 1 to 1. You're gonna get $100 in a dividend payment. You're gonna get $100 in a dividend payment. Dividend payments usually come out every quarter. That's every 3 months. When they pay out that dividend will go to your brokerage account. It'll show up in your cash balance. It'll show up in your cash balance. And there's something else called the drip method. The drip method is simply when you take those dividends and you reinvest them back into the dividend stock or the dividend ETF in which paid you to continue to get that compounding interest and that growth. So, dividends simply is when a company has excess money, they want to reward their shareholders. So, they pay out that money to the shareholders, and the shareholders benefit by holding the stock. The company benefits by you buying and holding the stock. That's how they get capital. And then they reward you for being a loyal shareholder with the dividend payment. Now, there's some dates you need to remember when we're talking about dividends. There's the declaration date. The declaration date is the date when the company announces it will pay a dividend, including the amount and the other key dates. You have the ex dividend date. This is the date or after which a stock traded without the right to receive the most recently declared dividend. Have the record date. This is the date which you must be on the company's books as a shareholder to be eligible for the dividend. And the payment date, that's the date they're paying out. So let's make it simple. Declaration date. Let's say on January 1st of this year, the company declared, we're going to pay a dividend. Let's say Microsoft. Microsoft's a dividend stock. And when you're talking about a dividend stock is merely a company that pays dividends. Every company doesn't pay dividends. Every company doesn't pay dividends. Go do your research. Look into what companies pay dividends. If you want to add dividend stocks to your portfolio, it's a great way to build wealth. Or if you want to go to the dividend ETF route, I mentioned SCHD is a great dividend ETF that pays out dividends. But back to the 4 days. So on January 1st of this year, let's say Microsoft announces we're going to pay out a dividend. We say, for example, we have 1 million shares outstanding. We're going to pay out $1 million in dividends. That means for every share, you're going to get $1. Every share you're going to get $1. So we announce January 1st, we're going to pay out a dividend. That's the declaration date. Now, the ex-dividend date, let's say that's set for January 10th. That means that you need to have already had that stock before that date. You have to already have your shares before the ex-dividend date. If you buy your shares on or after that ex-dividend date, you are no longer valid to receive the dividend payment. You got me? So on January 1st, they declare we're going to pay out a dividend. We're going to pay out a dividend. That's the declaration date. Ex-dividend date is January 10th. You got to have them shares locked in before January 10th, or you're not going to be eligible for this dividend payment. You can't buy them the day of or after. You got to have them before the ex-dividend date. Now, the record date. So remember, they declared on the 1st. The ex-dividend date is on the 10th. You got to have them before the 10th. And now the record date, let's say the record date is on January 12th. That's the day when the company, okay, we're going to look at our books. We're going to say who all's been holding shares, when did they have them, how many they have. They're going to run the books. They're going to run the books and they're going to say, all right, you had 100 shares in my company. You had 100 shares in my company before the ex-dividend date. And now we get to the payout date. The payout date is going to be on January 20th. So on January 20th, you can expect that $100 dividend payment to hit your account. Because remember, we're giving a million shares outstanding. We want to give away $1 million dividend payment. You have 100 shares, so you're going to get $1 per share. That's $100. That's what a dividend is. It's that simple, that easy. It's that simple, that easy. We ain't got to make it complicated. Investing is easy. Now, when we're talking about dividends, we're talking about any of these terms I just talked about, the declaration date, the ex-dividend date, the record date, the payment date, anything you want to know about dividends, going on over to investopedia.com. I told you about that. That's a great resource. Go to investopedia.com, search dividends, and it's going to give you all the information you need to know about dividends. All the information you need to know about dividends. But I had to make this video because I was getting questions about dividends. That's what a dividend is. It ain't hard. It's easy. It's easy, man. I have dividend stocks in my portfolio. I have a dividend ETF because I think it's a great way to build wealth. Yes, it's slow burn, but over time, you're going to get that compounding interest and you're going to accumulate more shares and more shares and more shares. And eventually, that dividend payment is going to get bigger and bigger and bigger. And I don't know about you, but with the plan I have for my portfolio in the next 10 to 15 years, my dividend payments is going to be ridiculous. You're talking about tens of thousands of dollars in dividend payments. Tens of thousands of dollars in dividend payments. You heard that right. That's what this thing can lead to. Get them shares. Get them shares. But look, man, if you found value in this video, please like, share, and subscribe. Man, I got a lot more videos coming. Rock with your boy, man. Rock with your boy. I'll see you on the next one.